let me start with a question that might hurt a little. Have you ever bought crypto or stocks at exactly the wrong moment? Like you wait, hesitate, think you're being smart, finally click buy, and then the chart instantly drops like it heard you coming. If that's you, don't worry. You're not cursed. You're not unlucky. You're normal. Pretty much everyone has done it, including me, and probably everyone watching this video. And that's exactly why today we're talking about a strategy that quietly saves beginners from emotional disasters: dollar cost averaging, or simply DCA. Now the good news, you don't need to be a market genius to understand this. No advanced charts, no complicated trading signals, no guru strategies. DCA is simple, like I could explain this to my dog simple. And in volatile markets, DCA can make the difference between staying calm and panic buying at 3 a.m. because some influencer tweeted a rocket emoji. Now you're probably wondering what DCA actually is, so let's break it down like a normal human would. Instead of trying to guess when the market will go up or down, which even experts fail at, you invest the same amount of money at regular intervals. It doesn't matter if the price is high, low, or doing something strange. You buy anyway. Over time, that spreads out your entry price and protects you from the "oops, I bought the top" moment that so many beginners experience. It's not glamorous, it's not flashy, but it's reliable. And reliability in crypto, that's basically treasure. Most beginners think their biggest enemy is volatility, but in reality, it's emotion. People see green candles and feel FOMO. They see red candles and panic. They watch influencers make wild predictions, see charts that look like earthquakes, and suddenly they're making decisions based on fear rather than logic. DCA helps you dodge that. It forces you to stick to a plan instead of reacting to whatever chaos the market throws at you. The reason DCA works so well in volatile markets is actually pretty intuitive. When the price drops, your fixed amount buys more units. When the price rises, it buys fewer. Without doing anything complicated, you naturally accumulate more at cheaper prices and slow down when things get expensive. It's like hitting cruise control during a storm. You stop oversteering and let consistency do the work for you. To really understand why this strategy is so effective, you have to think about what volatility actually means. In crypto, it doesn't just mean the price moves, it means the price overreacts. It swings too far up, too far down, too quickly, too emotionally. And that's where most people mess up. They try to predict these swings. They think they'll buy at the bottom and sell at the top, even though nobody has ever consistently done that, not even professionals. DCA doesn't try to fight volatility or outsmart it. It just adapts to it. Now let me tell you something that a lot of people won't say out loud. Timing the market is impossible. Sure, you'll get lucky once in a while, but luck isn't a strategy you want to bet your money on. Think about it. If people could consistently predict the bottom, everyone would be rich. There would be no dips left to buy. The reason dips exist is because everyone is confused at the same time. DCA removes the need for prediction entirely. You don't need to guess anything. You just show up consistently. So if DCA is so simple and so effective, why doesn't everyone use it? Because people love the idea of quick money. They want the perfect entry. They want the big win. They want the story they can brag about to their friends. DCA doesn't give you a dramatic story. It gives you results in the long run, but not dopamine in the short run. It's disciplined, not flashy. It's logical, not emotional. And that's why it works. Now, let's talk about how you actually begin with DCA. A few years ago, not every platform supported automatic recurring buys. Now, pretty much all major exchanges do. Coinbase, Binance, Kraken, and many others let you schedule weekly or monthly purchases. You pick an amount, choose a day, and the system takes care of the rest. It's honestly harder to forget your own birthday than to mess up DCA once it's automated. As for how much you should invest, that's entirely up to your financial comfort zone. Some people DCA with $10 a week, some with $100, some with more. The amount matters way less than the consistency. What matters even more is what you DCA into. You want assets with strong fundamentals and long-term potential. Bitcoin and major index funds in traditional finance are the classic choices. You want something that historically grows over time, maybe not Space Frog Ultra 2.0, just a suggestion. Now that we've covered the basics, let's walk through what actually happens when you DCA for months or years. At first, it feels almost too slow. You're putting in your set amount, the market goes up, down, sideways, and it doesn't feel like much is happening. But what you don't see is the long-term compounding effect quietly doing its job. Over time, your average entry price stabilizes. You accumulate more during dips. You reduce your exposure during peaks without even trying. And one day you look back at your total holdings and think, oh, that actually added up. One of the sneaky advantages of DCA is that it keeps you invested long enough to experience major market cycles. Most beginners don't survive a full cycle. They buy during hype, panic during drops, and quit when things look bad, right before things get good again. DCA keeps you in the game during the boring periods, the scary dips, and the unpredictable swings. And staying in the game is half the battle. Now, to be fair, DCA has downsides too, and you should know them. The most obvious one, if the market suddenly crashes and then skyrockets straight back up, buying a large amount at the bottom would have been better. But again, nobody knows when that bottom is until it's already gone. Another downside is that DCA works best with assets that grow in the long term. If you DCA into something that has no fundamental value or something extremely speculative, consistency won't save you. DCA is a strategy, not magic. There's also the psychological part. DCA requires patience, real patience. Not, I waited 2 days, where are my gains patience? It requires understanding that wealth grows slowly at first and then accelerates. If you're someone who expects instant results, DCA might frustrate you. But if you're someone who values stability over stress, it's a blessing. Let's make this real with a simple example. Imagine you invest $40 every week into Bitcoin for a full year. Over that year, the price moves up and down like a roller coaster built by someone who hates seatbelts. Your weekly buys happen anyway. Some weeks you get more Bitcoin, some weeks less. But at the end of the year, your average entry price ends up far more balanced than if you had tried to guess the perfect moment. Meanwhile, someone who dumped all their money in at one random moment might be celebrating or crying. And typically, beginners choose the crying option by accident. Another thing worth mentioning is that DCA is great for building discipline. It teaches you to stick to a plan instead of chasing hype. It gives structure to your investing instead of letting emotions take control. And that's something even experienced investors struggle with. Now, before you walk away thinking DCA is the only strategy in the world, let me be clear, it's not. There are other strategies. Some are more advanced, some require more time and skill. But DCA is one of the few strategies that works extremely well for beginners, requires almost zero maintenance, and performs especially strongly in volatile markets, which is pretty much the only kind we have anymore.